Our theme this week is equilibrium in process. Financial markets finding economic equilibrium is a dynamic process, especially in the moment. As investors, we encounter the day-to-day gyrations of market pricing in risk and expectations with macro trends and the 24-hour news cycle. In the short term, these movements can feel choppy. We'll start with checking in on some recent market and economic data points, and then zoom out to see where there is equilibrium in process. In recent weeks, the cost of borrowing to buy a home has increased quite substantially. Just this year, the 30-year mortgage rate has increased from about 3.1% to about 4.1%. Now, this is a big move in a short time period, and it could have adverse impacts on real estate prices, given that home affordability goes down as borrowing costs go up. If we zoom out, we find that over the past 10 years, mortgage rates have averaged about 3.8%, which is not far from the current levels. What you can tell from this chart, though, is that rarely have we seen mortgage rates stay at the average for any length of time, but rather swings back and forth as the market establishes the longer-term equilibrium. Next, let's look at short-term interest rates, which the Federal Reserve or the Fed has direct control over. A week ago, the Fed voted to increase short-term interest rates about 0.25%. Now, this occurs after rates have been held near zero for the past 2 years. The Fed is doing this in an attempt to combat elevated inflation. Higher interest rates have the effect of putting more restriction on economic activity, again, with the end goal of trying to cool down inflation levels. Based on current data, we are not far from the average here. However, we also don't anticipate staying close to the average for long. In fact, the market now anticipates the Fed will increase short-term interest rates an additional 5 to 7 times this year, which means we could see short-term rates trend higher and cross over the average. As a side note, with short-term interest rates rising this year, we do expect to see greater interest being earned on bank savings accounts, which is good news for savers. Now, on the topic of inflation levels, we recognize that the government's measurement of both consumer prices and producer prices are rising to levels not seen since the early 1980s. Although this graph looks like the left-hand side of the Eiffel Tower, it is unlikely to stay this high forever. Because prices are being compared to levels 1 year ago, there's what's called a base effect occurring. This just means that measurements today are compared to levels of a year ago that were substantially lower. Now, we expect that price inflation will continue. However, in terms of rate of change, the level we see here, we anticipate will trend lower. What does this all mean from an investment standpoint? Well, we acknowledge that the markets and economies can be out of equilibrium in the short term. Creating equilibrium is a process that can take time. This is why we stick to the plan we create together. We remain diversified across various asset types and time periods, and we invest into assets that can keep pace with inflation over time.